Hi, everybody. Good afternoon. Thank you for joining us for this webinar on this Thursday afternoon. So glad to see so many of you all joining us today. So quickly, a brief introduction. I am Priya and I have Dhairya with me, and we are part of Treelife, where we work with startups and investors, and we help them with their legal, finance, tax issues, right? And fund setup is also something that we do quite actively. So having been around in the system for a while, and having interacted with many of you guys, right? We thought that maybe worthwhile to host a session on the basics of AIF, right? So this session is for people who have heard about AIFs but don't know what it exactly is, want to understand the contours of it, want to understand what are the parties involved and what are the basic considerations, right, that you need to keep in mind when you're thinking of setting up an AIF or thinking of investing in an AIF, or as a startup founder looking at raising funds and you have an AIF investor. So what things that you need to keep in mind, right? So the intent today is going to be to cover the basics of what AIF is, what are the common terms you see when you read about AIFs, and kind of cover ground on that aspect, right? So quickly, I hope all of you all can see my screen. We'll quickly dive right in, right? Quickly, to spend a minute on what we are going to cover today. We're going to spend some time to just give you all an introduction to what AIFs are. Then we'll look at what are the regulations for AIFs, right? We'll cover SEBI regulations, we'll cover tax regulations, and then we'll come to how to get registered as an AIF, right? Because there's a process around it. There are some documentation that goes into setting up an AIF, etc., right? And then after that, we'll open the floor for questions, and happy to take questions that everybody may have, right? In the meantime, feel free to post your questions on the chat and feel free to answer these polls that we are putting out for you guys. It will just help us navigate the webinar in a better direction so that all your questions are answered. We'll try and take up answers to questions as we move along, but if any question is unanswered, we'll try and take it up at the end. Right, so diving right in, right? So introduction to AIFs, right? So now what is an AIF, right? The full form of AIF is an alternative investment fund, right? Lately, it has really picked up speed in terms of the awareness of it and also the implementation and the setup of AIFs, right? So what is an AIF, right? It's an alternative investment vehicle, right? So people generally invest in stocks, in real estate, in debt, and these are the typical, traditional investment routes, right? And AIF is a more mature, sophisticated investment vehicle, right, where you get to diversify your portfolio into a different kind of asset type, right, where basically it's like an investment vehicle which is managed by experienced fund managers who will basically manage your money, right? So it's like a PMS, but a more sophisticated version of that, where sophisticated investors come together, pool money in a fund, and that fund is managed by experienced fund managers, where they take the investment divestment decisions, they source deals, and they basically deploy your money so that the returns are much more as compared to traditional investments, right? Some quick stats, right? There are more than 1,500 registered AIFs as of today in India, right? And if you see the diagram on your right, you can see the uptick, right? The commitments that have been raised by AIFs in India has significantly increased over the years, right? If you see from FY21, there is a very clear hockey stick growth that we can see, right? Because 21 COVID, that was the time where startup investments really picked up, and that kind of shows in the number of AIFs and the commitments that have been raised by AIFs year on year, right? So as I mentioned, the commitments are surging incrementally, right? Last 2 years, there's a 77% increment. Also, one interesting fact is that equity AIFs, right, they have outperformed the BSE Sensex Tri Index PME Plus, right, for 5 consecutive years, right? Now, this is a great catch for people to kind of start looking at AIFs more seriously and trying to genuinely think of that as an alternative investment route for them, right? Where they want to diversify their portfolio, then AIF becomes a great asset class. Now, as we go further, you will understand that there are 3 categories of AIFs. There's category 1, 2, 3. 1 and 2 being more popular than 3. 80% of the current AIFs are under category 1 and 2, and the balance 20% will be category 3, right? And one other interesting thing to note here is that we are seeing a lot of first-time fund managers kind of venturing into an AIF route, right? Like earlier, people used to kind of do this, managing people's money, but in a more unstructured, unregulated kind of a structure. But many people are now kind of tilting towards this formal SEBI structure of setting up an AIF and then managing money in a more regulated, in a more structured approach, right? And that we can see by this stat, which basically says that 44% of the AIFs that were set up in the last couple of years were launched by first-time fund managers, right? So more and more the younger strata of the Indian society are now looking at becoming fund managers, setting up AIFs, managing money, right? So all this kind of tells us how deep the AIF understanding is across India and how it's becoming the new asset class where everybody wants to invest in, and also becoming very lucrative as a career option, right? Where people want to become fund managers, they want to set up their own AIF because the upside for fund managers is also pretty high, right? So that tells us a little bit about AIFs, right? Now moving to how a typical structure of an AIF looks like, right? You guys must have seen this diagram time and again. It's a very common diagram, but just quickly to take you all through what it is, right? So the triangle in the middle that you can see is your AIF. Now, just quickly to give you a little bit brief is that SEBI allows you to set up your AIF in the form of a trust, a company, LLP, or any other body corporate. But typically everybody sets up their AIF as a trust, right? Because that is more tax efficient. Also, there are other benefits over an LLP as regards to confidentiality. Right now, when your AIF is set up as a trust, you need a trustee, right? Because that becomes your administrative body for an AIF set up as a trust, right? You also need a custodian, which now SEBI mandates all AIFs to have, right? Then on your right, you will see a sponsor, right? Now, who is a sponsor? A sponsor is basically the face of an AIF, right? Where basically we say that this person is going to show their skin in the game in the AIF, which will give investors the comfort to put money, right? So if basically what it does is that for the investors, they will look at the sponsor as somebody who's setting up the AIF and also putting their skin in the game, right? So SEBI mandates sponsors to put minimum commitment in the AIF, which means that their money is also at stake while the AIF makes returns or doesn't make returns. Now, on your left, you'll see an investment manager. An investment manager is the brain of the AIF in simple terms, right? So the investment manager is somebody who has experience, education criteria, it fulfills the education criteria and has taken certifications as mandated by SEBI and kind of is the brain of the AIF. It takes the investment divestment decisions for the AIF. Okay. For this, they earn management fees and also carry, right? So, and on top, you will see investors. An AIF is allowed to raise money from Indian and foreign investors. There is no bar on that. FDI policy permits for non-residents to kind of invest in Indian AIFs, right? And downward arrow, which you see, is basically the investment that the AIF makes into portfolio companies, right? So basically, the AIF is a pooling vehicle where all the investors pool their money along with the commitment from the sponsor, and that entire pool of money is then deployed into portfolio companies, and that deployment is something that is managed by the investment manager. Then there are other parties like your custodian, trustee, merchant banker, etc., which are required from a SEBI perspective, but these are your main parties of an AIF, right? So this is how typically an AIF structure would look like. Moving on to some key terms, right? Whenever you hear about AIFs, you will hear these terms, right? Carry, hurdle rate, catch up, waterfall, all of this, right? So quickly to give you all a brief idea of what these terms mean, right? So carry is basically a performance fee, right? It's an upside, it's an incentive for the investment manager to kind of ensure that the deployment is done in a way that the investors make returns, right? So in addition to the management fee of 2% or 1%, whatever is agreed, there is a carry, right? Which is kind of like an incentive for the manager to ensure that the returns for the investors are high, right? Now, carry is basically in the range of 15 to 20% of whatever the profits the AIF makes in excess of any thresholds, right? So the carry is the additional incentive for the investment manager, right? Where they get a share in the profits of the AIF. Generally, you all might have heard 80-20, which basically means that beyond the threshold of hurdle rate, whatever returns the AIF makes is shared in the ratio of 20% to the manager, and the balance 80% goes to the investors. The next is a hurdle rate. A hurdle rate is something that is promised to an investor, promised in the sense that any returns that the AIF makes, first the returns will go towards fulfilling the hurdle rate for the investors before anything goes to the manager, right? So it's kind of like a minimum return that is kind of guaranteed before the investment manager takes any share in the pie. Coming to catch up, right? Now catch up is basically allows the investment manager to kind of earn that hurdle rate on its investment, right? As an investment manager also, investment managers also kind of put their money in the AIF for their skin in the game. So a catch up is something that allows the investment manager to earn the hurdle rate akin to the investors, but only after the investors have earned their hurdle. Okay, now distribution waterfall, right? So a distribution waterfall is like a priority, right? Typically, how a distribution waterfall works is that if 100 rupees was collected by the AIF and then deployed, and say for example it makes 500, okay, then how that 500 is distributed is kind of what a distribution waterfall is, right? Say for example, now how a typical distribution waterfall will work like this, that the 500 is first given to return the capital of all the investors. So that means 500, 100 will go out of that 500 to give all the capital. Balance remains 400. Say for example, there's a 10% hurdle. Then the next distribution it will happen is all the hurdle will go to the investors. Then say if there's a catch up, then the investment manager gets a catch up on the hurdle. And then the last, whatever is left, right, is distributed in the ratio of 80-20 between the investors and the investment manager, right? So now how this is kind of drafted, what priority is there, and what how this is drafted in the PPM, it's basically called as a distribution waterfall. Okay, now coming to commitment period. Commitment period is basically the period during which capital commitments may be drawn from investors. Okay, so typically how an AIF works is that when I want to say invest in an AIF, I don't need to give all the money upfront. Okay, I just need to commit that I will commit, say, minimum 1 crore, right? I say that I will commit 1 crore to the fund. As in when the fund manager starts seeing opportunities, starts identifying deals, and when it wants to actually make the investment is when it will do a drawdown from its investors, right? So the commitment period is the period during which such drawdowns may be done by the investors, right? So the commitment period basically becomes the window in which the investment manager basically deploys the money, right? And closing is basically a date on which the investment manager takes as a cutoff to take capital commitment from investors, right? So typically a closing means that the fund has closed at, say, 1,000 crores, which means that they have obtained a commitment of 1,000 crores, which will then now start be deployed by the manager. So these were some key terms which we thought that, you know, people keep hearing about, but may not actually know what it really means. So we just thought we'll shed some light there. Moving on, we'll move to the regulations for AIFs, right? So to spend just 30 seconds, SEBI is the governing body for AIFs. Earlier, before 2012, there were VCF regulations, which were venture capital fund regulations. And post 2012, SEBI has introduced the AIF regulations, which has evolved over time and keeps evolving every day. In fact, there was an update yesterday, right? So I'll hand it over to Dhairya, who will take you through the regulations.
Yeah, thanks, Priya. I believe you have very nicely explained the basics of the AIF ecosystem as a whole. Now, as we delve down into the regulatory aspects of setting up an AIF, the SEBI regime for AIF broadly divides the different categories of AIF into three broad categories depending on the investment strategy that an AIF has. Like, for instance, if an AIF is intending to invest only and only into startups or an early stage venture or a social venture or in stressed assets, then they have to seek registration as a category 1 AIF, which also includes angel funds, special situations funds as a subcategory under category 1 AIF. Apart from this, if an AIF wants to invest only majorly into listed space with some diverse and complex trading strategies, then they have to seek registration as a category 3 AIF. The interesting aspect here is category 3 AIFs are allowed to invest primarily in listed space, meaning thereby they have to invest more than equal to 50% of the corpus in the listed securities. And some examples of a category 3 AIFs are hedge funds or a long only fund for investing in listed space, while anything which does not qualify under category 1 or 3 is qualifying as a category 2 AIF. Basically, this category 2 is a residual of what does not fall under category 1 and 3. So some predominant examples of a category 2 AIFs are private equity funds, which invest primarily in unlisted space, real estate funds, structured credit funds, debt funds are some examples of category 2 AIF. Here, the criteria for category 2 AIF is that it has to invest primarily in unlisted securities, meaning thereby it has to invest more than equal to 50% of its corpus in unlisted securities. So this is a distinction between Cat 2 and Cat 3. So the fund managers, depending on where they want to invest more than 50% of the corpus, generally decide on an ideal category where it is a mix of investment in listed as well as unlisted space. Interestingly, very recently, SEBI has also included investments in listed debt securities rated A or below as a permissible investment within category 2 AIF, meaning thereby, although a category 2 AIF invests in those listed debt securities, it would still qualify as an unlisted investment only, thereby ensuring that it clubbed together with other unlisted investments is considered for reckoning the primary investment in unlisted securities threshold. This was a broad overview of the different categories of AIF. Now we move further on to the key conditions or key requirements for different categories of AIF. The first one being minimum corpus requirement. So any category of AIF is generally required to have a minimum corpus of 20 CRs, while there are certain exceptions to it. Like, for instance, an angel fund has to have a minimum corpus of 5 crore, while a special situation fund has to have a corpus of 100 crores. Now going on to the other criteria, that is minimum investment per investor. Again, it is generally 1 crore per investor, while there are exceptions for investment by employees or sponsor manager entity, etc. Now, one most important commercial aspect is what is the minimum percentage contribution by the sponsor manager entity to the AIF. This is different for Cat 1 to vis-a-vis for a Cat 3 AIF. For a Cat 1 to AIF, the sponsor has to commit minimum 2.5% of the corpus of the fund or 5 crores, whichever is lower. While for Cat 3, it is 2.5% or 10 crores, whichever is lower. By having this condition, SEBI intends to ensure that the sponsor is also having an equivalent or an appropriate skin in the game in the overall corpus of the fund, so as to ensure that it is not only the money of investors which is being managed by the manager, but it is also his own money coupled with the investor money that is being managed by the sponsor. Now going on to the tenure, the category 1 and 2 AIFs can be only close-ended funds, and it has to have a minimum tenure of 3 years, which can be extendable further with the consent of investors, while a Cat 3 AIF can be open-ended or close-ended as may be decided by the fund manager. Now going on to the another important aspect, that is whether any of the categories of AIF are eligible for borrowing or undertaking leverage, and if yes, what's the limit. While for category 1 and 2, it's generally no, but they can borrow in certain exceptional situations, such as for meeting their temporary funding requirement, that too for a period not exceeding 30 days. And the instances of such borrowing during a particular year should not exceed 4 times in a year. Apart from this, there is also a monetary threshold on the borrowing amount that category 1 and 2 AIF can borrow, which is like a lower of following 3 amounts: 10% of investable funds, or 20% of the proposed investment in the investee company, or the any amount of undrawn commitment from investors other than the defaulting investors. So the lower of above 3 amounts is the maximum amount that a category 1 and 2 AIF can borrow for meeting the temporary funding requirements, while a Cat 3 AIF is allowed to engage in leverage and do borrowing up to 2 times of the NAV of the fund. There are certain calculation mechanisms for how to arrive at the 2x of NAV, which is prescribed by SEBI separately. Going on to another key aspects on the next slide. So there is a restriction as to maximum number of investors that a AIF can onboard, and that number is 1,000 investors, meaning thereby any AIF cannot have more than 1,000 number of investors onboarded with it. Another aspect of an AIF is a diversification norm, that is how much is the exposure that an AIF is allowed to have in a single entity. Here it is interesting to know that since category 1 and 2 are majorly for investment in unlisted space, the limit is 25% per investee entity, meaning thereby a AIF cannot invest more than 25% of its corpus in one single investee entity where it is registered as a category 1 or 2 AIF. While for Cat 3, considering that it invests in listed entities, the diversification norms are more stringent here, and here it is only 10% of the NAV of the fund which the AIF can invest in a single investee entity. So this was a distinction as to the permissible investment in a single entity. Accordingly, where an AIF intends to do investments in both listed and unlisted space, and the ratio of investments in listed and unlisted is decided, this diversification norm becomes an important criteria for determining an applicable category of AIF for seeking registration. Now, going on to the another important aspects, whether the AIFs are allowed to invest in overseas securities. Answer is yes, but it is subject to certain conditions. One of them being the AIFs are allowed to invest only 25% of the overall investable funds in overseas securities. that is also subject to certain regulatory reporting requirements, which says that any AIF intending to invest overseas is required to first seek an approval from an SEBI by making an application in prescribed format, wherein SEBI gives an approval for making the overseas investment, and that approvals are subject to overall AIF industry-wide limit of USD 1500 million, meaning thereby AIF intending to invest overseas has to ensure that the overall limit has not exhausted. Otherwise, it will have to wait in a queue on a first come first serve basis, wherein once the unit is first once the limit is first available, only then it will be allowed to invest overseas. This was with regards to overseas investment. Now going on to another aspect with regards to investment in other AIFs, investment in units of other AIFs. Category 1 and 2 AIFs are allowed to invest only in units of other Cat 1, 2 AIFs and not in Cat 3 AIF, while a Category 3 AIF is allowed to invest in units of any of the Category 1, 2, 3 AIFs. Now going on to another important aspect which is very peculiar, that is satisfaction of educational criteria by key investment team member of the sponsor manager entity. The SEBI regulations mandate that at least one key person of the investment manager team has to pass NISM exam on AIFs, and it also specifies that one of the key persons should have a relevant educational qualification as mentioned herein. And it is important to note that both education qualification and NISM examination criteria can be satisfied by a single person altogether. So delving down a bit further into the NISM examination, the examination is for 150 marks, wherein an individual has to appear online on the NISM exam, where the passing criteria is 60% with a negative marking since it's an MCQ based exam, and the registration fees for that exam are around about 3,000 rupees. Here, another important aspect that people often look through is it is not necessary that the partners stroke shareholders of the investment manager entity have to pass this exam. It can be any employee of the sponsor manager entity as well who has passed this NISM exam and can act as an investment officer or key investment team member of the AIF. This was all about broad implications or broad key conditions for setting up an AIF under different categories. Now we move further into compliance aspects of an AIF, which they have to generally do. So generally, AIF has to submit a report to investors on an annual basis. This is mainly for Cat 1 to AIF since they invest in unlisted space, to give details of the investee entity in which they have invested along with the valuation and NAV computation. Apart from this, they also all the AIFs have to, investment managers of the AIF have to prepare one compliance state test report which is submitted to the trustee for onward submission to the SEBI on an annual basis within 30 days of the end of financial year. And the AIFs also have to file periodic quarterly report to the SEBI wherein they have to disclose the details of investment made in investee entities along with sectoral bifurcation, along with the geographical bifurcation of investments within India or outside India. And this report is required to be submitted quarterly by all the AIFs, while there is one exception that a Cat 3 AIF which is undertaking leverage has to submit this report on a monthly basis. Apart from this, a AIF receiving money from a foreign investor has to file Form INVI on RBI's firms portal. And there are certain ongoing compliances that the AIFs need to do, AIF and the sponsor manager entity need to do in the form of income tax return filing, TDS filing, GST filing as applicable in routine scenarios. Also, since for Cat 1 to AIF, the income which is earned by AIF is in pass-through nature, they are also required to issue Form 64C to all the investors for them to determine the income which is taxable in their hand, along with a bifurcation as to the nature of income, that is a capital gain income or interest income or any other nature of income. while the category 1 and 2 AIFs also have to file a console report of this income to income tax authorities in 64D. This was briefly about regulatory compliances. There are certain other compliances as well, which are like applicable as and when a condition is triggered. We have tried to cover a basic bare minimum compliances that are applicable to AIFs here. Now going on to the most important aspect of AIF is what are the tax implications for the AIF. The tax implications for the AIF and investors are distinguished into two different parts. One is for Cat 1 to AIF, while the other is for Cat 3 AIF. For category 1 and 2 AIF, the taxation is at a individual investor level, meaning thereby the AIF is having a pass-through status. So any distribution by investee entity to the AIFs in case of a Cat 1 to AIF would not be subject to tax at the fund level, and it would be subject to tax only at the investor level. Accordingly, while at the time of distribution from investee entities to Cat 1 to AIF, there is no withholding. It is only when the AIF distributes to investor, there is withholding at the rate of 10% in case of payments to resident, and in case of non-resident, it is at applicable rate or under DTAA, subject to any beneficial rate under DTAA. Here it is important to also note that Budget 2025 had amended the definition of capital asset to specifically cover any investment by Cat 1 to AIFs as a capital asset, meaning thereby now there is no tax uncertainty as to classification of income earned by AIF registered as Cat 1 to under TGBP versus capital gain hand. Now, since the investments by Cat 1 to AIF are treated as capital assets, it is more or less certain that the income would be treated as a capital gains income. So this was for Cat 1 to. Going on to Cat 3 AIF, the Cat 3 AIF taxation rules are a bit more at trust level and a bit more relaxed as to any income which is earned by AIF is taxable at the trust level depending on the type of income. If it is a business income, it is taxable at an MMR rate. If it is not a business income, then it is taxable at applicable rates, including surcharge and cess, in the hands of AIF itself. And any distribution from the AIF to investors is tax-free for Cat 3 AIF. This was broadly about tax implications for category 1, 2, and 3 AIFs. One more important aspect to note here is for an AIF raising funds from foreign investors and investing in foreign securities, there are no tax implications either for AIF or for the investor, considering that AIF is just a pooling vehicle wherein it is investing overseas by raising funds from foreign-based investors. This is clarified by CBDT through a circular. So this is important to note. Apart from it, going on further, is how to register as an AIF. What is the procedure? What are the document requirements that AIF needs to take care of at the time of registering as an AIF? So here there is a brief process flow. It goes like, first, overall structure of the AIF has to be finalized. Based on the structure, key documents like PPM, trust deed, contribution agreement, etc. are prepared. Based on that, there various agencies are appointed in relation to the AIF, such as trustee, merchant banker, custodian, RTA. And as we spoke earlier, it has to be ensured that the investment manager team member clears an ASM examination. So if that is not cleared, that is also to be cleared parallelly with the preparation of fund documentation. And once all these requirements are satisfied, an application to SEBI is filed for registering as an AIF on SI portal online in Form A, along with certain bare minimum declarations, undertakings, net worth certificates, and all that document criteria which is specified by SEBI. Once this is done, SEBI generally gives approval in prescribed time limit, and post receipt of approval, you need to pay a registration fee for your AIF depending on the category, and then you can start raising commitments from the investor. This was a broad process flow for setting up an AIF. Now going on to the key document requirement for setting up an AIF. The key documents which are required for setting up an AIF are private placement memorandum, indenture of trust or trust deed as we call it, and the other two are contribution agreement and an investment manager agreement. While private placement memorandum is kind of a heart of the entire SEBI registration procedure, which covers end-to-end minute details of the overall AIF scheme, including the investment strategy, investment thesis which the fund intends to deploy, the details of investment manager and its key investment team, the management fees that the AIF intends to charge, the tenure of the scheme, any permissibility for redemption of units by the investors, the risk and the management, and the procedure for winding up of the AIF. All these aspects are covered within the document of within the PPM. So this is kind of a very exhaustive document which also covers tax aspects for the investors in it, and the regulatory aspects also are covered here in the PPM. This is PPM has to be certified by a merchant banker before submitting to SEBI. Once that is done, then and then only we can submit the PPM to SEBI. Now going on to the second document that we spoke, that is a trust deed. Trust deed is kind of an document which is executed between the trustee and the trust, and it is established by a settler who can be an individual or even a sponsor manager. Once this trust deed is executed, it needs to be registered with the registrar of the applicable state for obtaining PAN of the trust, that is the AIF. So it is important to note here that only the PPM and the trust deed is required to be filed with SEBI at the time of filing application for registering as an AIF. So in practice, what people generally do is they finalize PPM and the trust deed and submit the application to SEBI online, and they in parallel prepare and finalize contribution agreement and investment manager agreement. So the contribution agreement is generally a tripartite agreement between the contribution trust contributor or the investor, as we call, trustee, and the investment manager, wherein they each investor would sign this agreement for investing a particular amount that they decide, with a minimum requirement of 1 crore as we spoke earlier. And here there are basic terms which are defined in this agreement. Apart from this, there is investment manager agreement, investment management agreement, which is an agreement between the trustee and investment manager, wherein the trustee delegates certain power for management of the trust or the AIF, as we call, to the investment manager for managing the overall AIF. So this was broadly as to the documents requirement for setting up an AIF. Now going on to the fee structure. So SEBI has a fee structure divided in two parts. Any application that is filed with the SEBI for registering any category of AIF has to first accompany a payment of 1 lakh rupees plus applicable GST. Once the SEBI accords you a final registration for the respective category of AIF for which you applied, you need to pay a registration fee depending on the category of AIF. That is, for an angel fund, it is 2 lakh, while for Cat 1 AIF, it is 5 lakh, while for Cat 2 AIF, it is 10 lakh, and for Cat 3, it is 15 lakhs. One important point to note here is, in case of a change in control of sponsor or manager, this SEBI registration fee are to be paid again equivalent to the applicable category. So say for instance, if there was a Mr. X who was a sponsor manager of an Cat 1 AIF, and he is now no more the sponsor manager, but it is Mr. Y who is the sponsor manager of a Cat 1 AIF, then the AIF would have to repay the registration fee of 5 lakhs to SEBI along with an application for change in sponsor manager, which is to be reported to SEBI. So this was broadly for the fee structure. Now moving on to the another aspects, which are like some recent updates on around the AIF ecosystem and the SEBI regulations, which I will hand over Priya, my colleague, to take further.
Thanks, Daria. I think the large plethora of regulations around AIFs has been, we've tried to give you all a bird's eye overview of, what the regulations say. I'm happy to answer questions. We'll take we can see a lot of questions coming in. We'll take these questions at the end. Just quickly, right, before we open the floor for questions, some recent updates, right? So one thing is basically, SEBI has kind of extended the timeline for the DMAT requirement for AIF, which basically means that the investments which are held by the AIF needed to be held in DMAT form. Now, for new investments, that compliance requirement has been extended to 1st of July 2025 in line with the MCA announcement. And the existing investments need to be moved to DMAT by October 31st. Okay, and again, this requirement only applies to eligible entities for DMAT, which basically means small companies, etc. don't need to kind of follow this. And of course, investment in LLPs is not required to be dematerialized. One more interesting thing is that SEBI has recently come up with a cyber security and cyber resilience framework that all investment managers and all AIFs need to kind of comply with. There is a threshold basis the corpus of the AIF with regard to the kind of framework that they need to have. The deadline for that was 31st of March 2025, which has now been extended to 30th June, whereby all AIFs are required to comply with this new framework, right? Which basically requires you to set up a policy and set up an internal framework to kind of comply, ensure that there is no cybersecurity risk for the investors, right? Just like to just give you all like a sense of what it is, SEBI is generally investor friendly, where basically they keep coming up with new frameworks, policies, etc., amendments to the regulations to basically safeguard investors, right? Because SEBI is a governing body for AIFs. Their intent is always to ensure that investors are safeguarded. So they keep coming up with different guidelines which the investment managers have to adhere to, which kind of strengthen the safeguards that help the structure. One more thing was, one interesting thing is that a lot of people have started setting up AIFs to kind of circumvent the QIB benefits, because certain categories of AIFs do get a QIB benefit in IPOs. But to avoid any circumvention of rules, SEBI has kind of come out with additional due diligence requirements and compliance requirements for AIFs kind of wanting to take this QIB status, where basically they are kind of coming down on people who are trying to set up single investor AIFs to kind of get this QIB status, which they would not have gotten had they invested in their personal names. The NISM certification deadline for existing AIFs has been moved to 31st July. It was earlier 9th of May. I think somebody had asked this question. I hope this answers your question. And another recent update is that generally AIFs issue partly paid units to investors, because as I kind of explained before, commitment is done in at the beginning, but the drawdowns are called for from investors as and when the investment manager identifies opportunities for deployment. To kind of to ease the operational requirements, people end up issuing partly paid units, which are then made fully paid as and when drawdowns are made. There was a small dichotomy with regard to permissibility of AIFs to issue such partly paid units to non-resident investors, but lately, last week, they have come out with this. RBI has come out with a clarification that they were allowed to issue partly paid units, and any past such issue of partly paid units can now be regularized without any rate submission fees, right? So that kind of brings us to an end of our presentation. We are opening the floor for any questions. Happy to take the questions, right? While people ask questions, I'll quickly try and take a few questions which haven't been answered. I can see somebody had asked a question about master feeder fund, right? So generally how it works is a master feeder structure is where there are two AIFs, where two funds, right, where basically your non-resident investors kind of pool money into a feeder fund, which then kind of makes investment in the master fund, which is your SEBI registered AIF, right? Now, this is done for multiple reasons like investor comfort. So non-resident investors are sometimes wary of investing directly into Indian vehicles. So typically a vehicle is set up in like a Singapore, Mauritius, Cayman, all these investor friendly jurisdictions, also GIFT City for that matter, to allow non-residents to kind of pool their money into this fund outside India, and then that fund makes one single investment into the Indian AIF, right, which kind of aligns with the overall objective. So that's how a master feeder structure works. I will happy to connect separately to kind of give you more insights on that. I think most of the questions we've answered. Anybody has any other questions? Happy to take those. We are not going to cover the IFSC GIFT City because it will be too much to cover in one, but we do keep having webinars on GIFT City, FME regulations, all of that. So you can join one of those or write to us. I think we'll be happy to take you through those. Yeah, I think we've answered most of questions. Anybody has any additional questions, please feel free to kind of write to us.
There's one question from Aditya, which says, does a small company which has received investment from an angel fund require to convert its securities into demat? So Aditya, we would like to put in here that the SEBI regulations on compulsory dematerialization has an exception or a clarification saying that the investee entity has to dematerialize the securities only if it is required under the applicable provisions.
I can see somebody has raised their hand. Yes, Rahul. Rahul, are you saying something? We can't hear you. All right. I think then with that, I think we'll end this. Thank you so much for joining in. It was wonderful having you all. I hope we've answered your questions. We tried to answer all the questions on the go while you all were putting it in the chat. If we've missed anything, please write to us. We'll be happy to connect. And thank you. Thank you so much for your time.